Hello, I'm Clara Morgan. There is a very specific, quiet moment that happens in a person's financial life. It usually occurs late at night or early in the morning when you're finally sitting down to review your accounts. You log in, the screen loads, and you see that number, $200,000. For most of my clients, hitting this milestone doesn't trigger a celebration. There are no fireworks. Instead, it's often accompanied by a strange sense of unease. You look at that balance and think, I've worked so hard for so long, and while this is more than I ever thought I'd have, it still doesn't feel like enough to actually stop. You do the quick math in your head, comparing $200,000 to the cost of a 30-year retirement, and you feel a pang of anxiety. You wonder if the next decade is going to be just as grueling as the last one. You wonder if you've reached the limit of what hard work can do. Today, I want to show you why that feeling, while completely normal, is actually hiding the most exciting truth in finance. If you are sitting on $200,000 in invested assets, you aren't just doing well. You have reached the inflection point. This is the exact moment where the laws of mathematics stop working against you and start doing the heavy lifting for you. But there's a catch. The strategies that got you to $200,000 are not the same ones that will take you to $2 million. In fact, if you don't shift your mindset right now, you risk sabotaging the most powerful wealth-building phase of your entire life. Let's talk about why $200,000 changes everything and how you need to change with it. The invisible threshold, where your money outworks you. Most people believe that building wealth is a linear process. They assume that if it took 10 years of the grind to save $200,000, then getting to $1 million will simply require 5 times more of that same exhausting effort. But wealth building isn't a straight line. It's a curve. Think back to the beginning. Getting from zero to your first $50,000 likely felt like pushing a boulder uphill. You were fighting against everything: taxes, living expenses, and the sheer gravity of small numbers. Then, moving from 50,000 to 100,000 took slightly less time, but it still required relentless manual discipline. By the time you hit $200,000, you've internalized a saver's identity. You believe that wealth is the result of your labor. But at $200,000, you cross an invisible threshold where your money starts earning more than you can realistically save from your paycheck. The math of the silent partner. Let's look at a practical example. Imagine a professional in the U.S. earning $80,000 a year. They are highly disciplined, saving 20% of their gross income. That's $16,000 a year, a fantastic accomplishment that requires real sacrifice. Now look at that $200,000 portfolio. If it's invested in a diversified basket of stocks, like an S&P 500 index fund, and earns an average historical return of 8%, that portfolio generates $16,000 in a single year without the owner lifting a finger. Do you see what just happened? Your money has officially become your equal in terms of productivity. You are working 40 to 50 hours a week to contribute $16,000, while your capital is matching that contribution just by existing. This is the moment when compounding stops being a nice idea in a textbook and becomes the primary driver of your net worth. The psychological transformation from saver to allocator. Once you hit this $200,000 mark, you have to undergo a fundamental identity shift. You are no longer just a saver. You are now an allocator. Up until now, your wealth was a product of your labor. You worked, you earned, you stayed under budget. But from this point forward, your wealth will primarily be a product of capital efficiency. The manager of the machine. I want you to stop thinking of your bank account as a stashed pile of cash and start thinking of it as a wealth machine. Your job is no longer to build the machine. You've already done that. Your new job is to manage and protect the machine. As an allocator, your decisions about where that capital sits, how much you pay in fees, and how you react to market volatility matter far more than whether or not you saved an extra $100 this month by skipping a dinner out. Clara's insight. When you have $5,000, a 1% difference in investment fees is $50. It's negligible. When you have $200,000, that same 1% is $2,000 a year. Over 20 years, that single allocator decision to move to a lower cost fund can be the difference between retiring 3 years earlier or 3 years later. Year 1, you end the year with $232,000. Your $16,000 contribution and your $16,000 in market returns are perfectly balanced. It's a 50-50 split between your work and your money's work. Year 5, you are sitting at roughly $314,000. To many, this feels like a slog. You've put in $80,000 of your own money over 5 years, and the account only grew by $114,000. It's easy to get discouraged here and think, is this it? Year 10, the breakout, you hit $508,000. This is where the magic becomes undeniable. Over these 10 years, you contributed $160,000, but the total growth was over $300,000. For the first time, the market growth has doubled your personal contributions. Year 15, you're at $821,000. Year 20, you cross the finish line with $1.3 million. Look at the final breakdown of that $1.3 million. Your original $200,000 and your subsequent contributions total about $520,000 of seed money. The remaining $780,000, the vast majority of your wealth, came from compounding. You didn't have to work harder in year 20 than you did in year 1. In fact, you worked the same amount. The only difference is that you gave the math enough room to run. The identity shift, protecting the compounding curve. As you move into this allocator phase, your primary enemy changes. It's no longer overspending on small luxuries, it's interrupting the curve. The biggest risk to a $200,000 portfolio isn't that you won't save enough, it's that you'll do something to break the momentum. At $200,000, the stakes are exponentially higher. The cost of panic. Let's look at a scenario that I see far too often. The market takes a standard cyclical dip of 25%. Suddenly, your $200,000 balance reads $150,000. Because you still have a saver's mindset, you view that $50,000 loss through the lens of your labor. You think, that's 3 years of my life. That's $50,000 I worked so hard to save, and it's just gone. This emotional pain leads to the most expensive mistake you can make, selling to stop the bleeding. You move to cash, promising yourself you'll get back in when things stabilize, but the market is a forward-looking machine. By the time it feels safe to you, the rebound has already happened. By selling, you didn't just lose $50,000 today, you broke the compounding curve. You essentially reset your wealth machine back to the year 2 or year 3 stage. That one emotional decision could cost you $300,000 to $400,000 in final retirement wealth because you robbed those dollars of the time they needed to double and quadruple. New leverage, career optimization versus investment optimization. When you're starting out with $10,000 or $20,000, your biggest lever is your career. If you get a $10,000 raise, it's a game changer. It might double your ability to save. But once you hit $200,000, the math of leverage shifts. If you spend all your energy negotiating for a $10,000 raise, but ignore your portfolio's performance, you're missing the forest for the trees. Why? Because a 5% increase in your annual investment returns on a $200,000 base is $10,000 a year. That $10,000 from your portfolio is cleaner than a raise. You don't have to pay more in payroll taxes on it in the same way. You don't have to work more hours, and you don't have to deal with a difficult boss to get it. I'm not saying you should stop trying to grow your career. I am saying that your investment optimization, the act of lowering fees, choosing the right asset allocation, and being tax efficient, now has the same financial weight as a major promotion. Most people never make this mental transition, and they leave hundreds of thousands of dollars on the table by focusing only on their salary. The lifestyle creep trap. $200,000 is the starting gun. This is perhaps the most dangerous part of the journey. When you hit $200,000, you finally feel like you can breathe. You've been disciplined for a long time. You've driven the older car, lived in the modest house, skipped the luxury vacations. You feel like you deserve a reward. So many people at this stage decide to buy the $40,000 luxury SUV or renovate the kitchen they've hated for 5 years. They justify it by saying, I have $200,000. I can afford a $40,000 car. But as an allocator, you must realize that a $40,000 purchase isn't a $40,000 decision. If you take $40,000 out of your compounding machine at age 35, you aren't just losing that cash, you are losing what that cash would have become by age 55. At 8% return, that $40,000 would have grown into roughly $186,000. When you buy that car, you are actually signing a check for nearly $200,000 of your future self's money. The people who retire with $3 million or $5 million didn't get there because they never spent money. They got there because they recognized that $200,000 wasn't the finish line, it was the starting gun. It was the moment the race actually began to get interesting. They chose to keep the seed in the ground so it could turn into a forest. Career power shift, the cushion effect. There is one incredible benefit to hitting $200,000 that isn't purely mathematical. It's psychological posture. When you have zero savings, you are a hostage to your job. You have to take whatever your boss gives you because you're 3 weeks away from a crisis. This desperation is palpable. It shows up in how you negotiate and how you carry yourself. But when you have $200,000, everything changes. While it's not enough to retire on, it is enough to provide years of runway. This gives you a subtle confidence. You can walk into a performance review or a job interview knowing that you don't need this specific job to survive. You have the power to say no to a toxic environment or wait for a better offer. Ironically, this lack of desperation often leads to better career outcomes. People who operate from a position of strength are respected more, paid more, and offered better opportunities. But this power only exists if the $200,000 stays in the account. If you spend it on lifestyle creep, you trade your career freedom for a leather interior and a monthly payment. You go right back to being a hostage. The comparison trap. Why boring is better. As your account grows, you'll be tempted to speed things up. You'll see a friend who made a 500% return on a speculative crypto coin, or a cousin who flipped a house for a $100,000 profit. Suddenly, your 8% return in a diversified index fund feels slow. This is the point where many people at $200,000 gamble away their progress. They take $50,000, a quarter of their hard-earned base, and put it into a hot investment they don't fully understand. If it fails, they haven't just lost money, they've lost years of time. They've chopped their compounding machine down at the knees. The most successful retirees I've ever worked with are almost always the boring ones. They're the ones who stayed the course, ignored the noise, and realized that consistency is the only true get-rich-quick scheme. Practical steps. Your $200,000 action plan. If you are at or near this milestone, here's exactly what I want you to do to ensure you don't sabotage your success. Number 1. Conduct a fee audit. Look at every fund you own. If you are paying more than 0.20% in expense ratios for your core holdings, you are leaking wealth. Move to low-cost index funds. Number 2, automate your peace of mind. Set your contributions to happen automatically. At this stage, you want to remove your emotions from the process as much as possible. Number 3, define your big purchase rule. Before spending more than $5,000, use a compounding calculator to see what that money would be worth in 20 years. If the future cost is worth it to you, proceed. If not, wait. Number 4, rebalance, don't react. Check your portfolio once or twice a year to ensure your asset allocation is still on target. If stocks have grown too much, sell a little and buy bonds, or vice versa. This forces you to buy low and sell high without making emotional guesses. Conclusion: the seed and the harvest. $200,000 is the most important milestone you will ever hit. Not because it buys you a Ferrari, but because it buys you momentum. It's the moment where the math of the universe finally decides to join your team. The path from 200,000 to 2 million is not 5 times harder than the path from 0 to 200,000. In many ways, it's easier as long as you stay out of your own way. Remember, $200,000 is a seed, not a reward. If you eat the seed now, you'll never see the harvest. But if you protect it, keep watering it with consistent contributions, and refuse to dig it up every time the market gets cold, you will eventually look at your accounts and see a number that doesn't just provide disbelief, but true, lasting freedom. You have worked so hard to get here. Don't stop now. Let the math do what it was designed to do. Your next step. I want you to take one concrete action today. I'd like you to go into your brokerage account and look at your year-to-date or last 12 months investment returns in dollars. Compare that dollar amount to the total amount of money you personally saved from your paycheck over that same period. Which number is bigger? Share your findings in the comments below. Are you at the point where your money is doing more work than you are, or are you getting close? I'd love to hear where you are on your journey. I'm Clara Morgan, and I'll see you in the next video.